Hello, this is Dee Dee Jones, and welcome to Money Mastery with Dee Dee. And today we have the perennially popular topic of IRS audits. What do I mean by that? Well, IRS audits are something that can befall any of us, but if you're self-employed, there are significant risk factors that make your chances of getting audited by the IRS sometimes 2 and 3 times higher than most other folks. Now, if you've been around for a while, you know IRS audits happen. You may or may not know how they select audits. Some audits are very random. Some are line item audits. Some are targeted audits. And folks who are self-employed really have a higher risk of those targeted audits. And we're going to talk about that in a moment. So if you're self-employed, you are reporting your income from that business venture on something called a Schedule C. Won't be a stranger to that. But it's really a gold mine for IRS agents to find things that you might have done wrong, because in their experience, many self-employed people claim excessive deductions and they may not report all of their income. So rule number 1, be honest. That may not avoid the audit, but if you do get audited, it's much less stressful if you know that the numbers you've reported are accurate and defensible. So we're going to talk about accuracy and defensible as we go through some of these. So, and honestly, these days, there are so many people reporting income on a Schedule C than we have in the past. Think of Uber drivers, Grubhub folks, all those sort of freelance folks who have side gigs. There's a big portion of the population who are using Schedule Cs that may or may not know different things that might attract unwanted attention from the IRS. So let's start with the first one in my list in no particular order. Meals and entertainment travel. That is a place where a lot of abuses can show up. Folks going, well, I own a property in Hawaii, so I'm going to travel there and take a 2-week vacation and deduct the whole thing under the guise that I'm inspecting my property. Well, I'm here to tell you that isn't likely to fly if they review your return. So something to keep in mind is to qualify for meal or entertainment deductions, you've got to keep detailed records. What do you need? You need the amount, the place, the people who were there, the business purpose. Can't, if you just write talk to business, that isn't adequate documentation. We discussed the Smith and Jones deal, for example, the nature of the discussion. We were talking a buyout or a merger or something along those lines. You must keep receipts for anything over $75 for any expense or lodging while traveling. If you don't have this kind of documentation, your deduction is not going to fly. The next topic is kind of a funny one. Making more money increases your risk of audit. Now, does that mean you shouldn't try and make money or maybe underreport it? Nope. This is just one of those risks that exists and probably cannot be worked around. As your income goes up, your risk of getting audited goes up. Folks who made over $1 million a couple of years ago, nearly a 6% chance of being audited. Don't know what that means. I mean, just the higher your income, the better your records had better be. On the flip side, though, if you don't make very much money, and think in terms if you have a business that's losing money every year, too many of those losses is going to make the IRS think you're actually not in business to be in business. It's just a hobby. So there's a whole area of law that refers to hobby loss rules. So to be eligible to deduct a loss, you must run the operation like in a business-like manner and have a reasonable expectation of making a profit. There are some general rules you can follow, like making a profit 3 out of every 5 years, or if you're breeding horses, there's even more generous rules. But the law presumes that you're in business to make a profit. Otherwise, you're going to have to answer some really tough questions. If you own a company that's multi-level marketing that sells toys and you have little kids and you just continue to lose money, they might think you're just in it to get the discounts on the toys, not really to make a profit. So number 4 on our list is claiming the home office deduction. That you can imagine if you're an IRS auditor, how easy it is to say, show me all the small businesses that took a home office deduction. I'm just going to focus on those because that's a place where people take advantage of the rules. Really easy to audit those targeted areas, much like anything in this list today. So just know that taking that home office deduction increases your risk. You've got two ways to take a home office deduction. There's the safe harbor, which has a maximum deduction of $1,500, or a more detailed one where you actually have specific expenses and specific square footage percentages applied to those expenses. If you use the more specific one, be sure to have all the documentation supporting the different expenses that you're putting into that home office deduction amount. So let's get to 5. This one's another really easy one. If I was an auditor, I'd totally use this criteria. If you use a vehicle in business and you indicate that it's used 100% for business, think about that. How many people have a car that they use for business and absolutely nothing else? They don't go to the grocery store in it. They don't pick up the kids. They don't run any errands. All they do is drive for business. They exist. But in my mind, in my imagination, that's not a very common situation. So be really careful about how you report the car and how much percentage is business. And remember that if you switch from claiming the car to mileage, you're going to have to track your mileage contemporaneously. So there's a lot of special rules around having a car in business that you'll want to make yourself familiar with. Number 6 on my list of 8 audit risks is engaging in currency transactions. And what that means, we're not talking Bitcoin and cyber currencies of that sort. We're talking cash. So the classic cash-based businesses are car washes or laundromats. People don't, maybe they are more now, but historically, you go in, you put money in the machine, it does its thing, and you go on. You can imagine how easy it would be to underreport the amount of money that you earned. So in those cases, the IRS might look at bank records of deposits that you've made to substantiate your income. And if there's more cash being deposited than you've reported on your return, you're in trouble. You get to explain all that. So be careful about how you report cash deposits. That having that cash-based business puts you at higher risk. Now, the next one, number 7 on our list, is rental property losses. Now, the rules around owning rental property, I think, are sort of interesting because they almost lend themselves to creating losses. But if you continue to have losses, the IRS is going to look at that more closely. Remember, losses are not deductible once your income hits a certain level. And so they do protect the IRS a little bit, but once you sell the property, all the losses can be deducted in that year. So the IRS is pulling returns on individuals who claim they're real estate professionals because real estate professionals can take all losses. Special rules around being a real estate professional. Basically, you have to work about half time to qualify for that status. If that's the status you want to claim, better be sure you've got documentation to back it up, or they're going to take those losses away from you. So losses around real estate can increase your risk of audit. And finally, and this isn't unique to self-employed people, but claiming day trading losses. So people who trade in securities have significant tax advantages compared to investors. The expenses of traders are fully deductible, yet reported on a Schedule C. And traders' profits are exempt from self-employment income. Wow, that's really a great deal. But losses of traders who make the special election under, just so you know, 475 subchapter F election, they're treated as ordinary losses that aren't subject to the $3,000 a year cap on capital losses. I know that sounded like gobbledygook, but if you're a day trader, you're familiar with this. In order to qualify as a trader, you must buy and sell securities frequently and look to make money on short-term swings in prices. Most of the folks I work with are long-term investors. They wouldn't qualify for this. To qualify, the trading activities must be continuous. Not a long-term investor is going to invest mainly for long-term appreciation and dividends and interest. And investors hold their securities for longer periods and sell much less often than traders. So there's a big difference there. Be sure you know the difference. Be sure if you want to be classified as a trader that you document that you do, in fact, qualify. So those are 8 areas that can increase your risk of audit. Some we can control for, some we can't. Just be ready. But more than anything, be sure you're smart about how you file your taxes. Understand what you need to report, understand what you need to document, and if all else fails, get some help with those questions. Thanks for joining us today. And a shout out to Laura. She likes the part about rental losses. Laura is an amazing property manager. And if you've got questions about rental properties, you can reach out to her as well. But we're here to help answer your questions about taxes and tax audit avoidance, and making sure that you're only paying the taxes that you need to. This has been Dee Dee Jones with Innovative Financial and Money Mastery with Dee Dee. See you next week.